Just quickly following up on a question from a subscriber asking, what are the most significant or important Forex trading currency correlations? Now, these correlations that we'll talk about is much more significant than just a simple heat map showing cross-currency correlations. In this video, we'll look at what fundamental, or let's call it macroeconomic correlations, we can observe in the major currencies. Now, the first one is a topic that we've talked about many times before, and that is, of course, risk sentiment. Now, there are essentially two types of currencies that are sensitive and correlated to changes in the risk, namely high beta currencies, and then, of course, safe haven currencies. Now, the Aussie, the Kiwi, the CAD, and normally your emerging market currencies like your ZAR, your Mexican peso, Russian ruble, and Chinese yuan are considered as high beta currencies. Thus, they're expected to appreciate during risk on sentiment, and they're expected to depreciate during risk of sentiment. Then we also have currencies like the Swiss franc, Japanese yen, and US dollar, which are considered safe haven currencies. So they're expected to appreciate during risk of sentiment and expected to depreciate during risk on sentiment. Now, this is one of the most important currency correlations to understand from both a macro fundamental, but also a very short-term sentiment point of view as well. Then we also have currencies that are correlated to certain commodities or exports. Now, keep in mind, some of the high beta currencies are often referred to as high beta, which alludes to the fact that they have a higher volatility. And the reason for that is mostly due to the dependence or correlation to specific commodities, which themselves are considered as riskier and more volatile assets. Now, certain currencies can be influenced and correlated to certain commodities due to their export dependency. For example, countries that export large amounts of a specific commodity will usually have a strong dependency on that commodity in terms of the economy, and can obviously thus influence the currency as well. Now, some of the most significant ones are Canada. Let's just quickly get an example for you guys on the screen of Canadian exports. Now, a good example, Canada, with their dependence on mineral products, which accounts for about 24% of total exports, and oil making up about 14% of total exports on its own. Now, this will also heavily apply to other oil-producing countries. Another example of that would be Russia. We can see in terms of Russian exports, oil itself contributing 28% of total exports there. Also, another example would be Norway, another big oil producer. You can see for Norway, 26% of exports is crude, and another 26% is petroleum gas. So very oil-rich countries, which is why we normally see the Norwegian kroner, Russian ruble, Canadian dollar all react strongly towards moves in terms of the oil prices. Then we also have correlations with something like the Aussie dollar with regards to iron ore. So if we just quickly see Australia, we can see 20% of total exports for Australia basically just comes from iron ore alone. So that is a very important one in terms of the Aussie dollar. Another one there is coal. Coal is a big export for Australia, also making up about 19% of exports. So keeping an eye on those two can be helpful for the Aussie dollar as well. Any massive drops or rises in iron ore prices or coal prices can obviously affect the Australian economy and can have an influence on the Aussie dollar. Another interesting correlation is the one for New Zealand. If we quickly open up New Zealand, we can see animal products makes up about 45% of total exports, of which the bulk of that is the dairy industry. Now, a few years back, a key factor to watch for the Kiwi dollar was the GDT index, or the Global Dairy Trade Index, which tracks dairy prices globally. However, the importance of that correlation has dulled down in recent years and isn't really a massive mover for the Kiwi dollar anymore, but it is something just to keep in mind. Now, then moving on to more subtle correlations with regards to exports, we can also have a look at Germany. Of course, Germany is a good example where we have 12% of exports only being in the auto industry or cars. Thus, any big or positive negative news for the automobile industry can affect the euro to some extent, as Germany is the largest contributor of total EU GDP. So when we get comments from the US administration, for example, that they want to place tariffs on European automobiles, that's obviously going to be negative for Germany and negative for the euro as well. Another subtle correlation with regards to exports is the UK. In the UK, 80% of all exports are actually services, the services industry. So that's a very big number for the economy. And that is often why we see things like services PMI metrics being very important for the pound. Now, then we also have currencies that are correlated or sensitive to export destinations. So the first and most obvious one is the Aussie dollar and its sensitivity to China. Now, if we just quickly look at this chart, we can see that for China, Australia only makes up about 5.5% of its imports, which isn't a real big deal for China. But comparing that to Australia, for Australia, they send over 35% of their exports to China alone, which is a very, very big deal for Australia. Thus, whenever something affects China, whether that's negatively or positively, we can expect some reaction in the Aussie dollar, which is why important economic data points in China can have an impact on the Aussie, and why the trade war and tensions between the US and China is weighing so heavily on the Aussie compared to some of the other more risk-sensitive currencies. Now, this also brings us to something like the pound and Brexit. Now, if we just quickly take a look at this chart in terms of UK exports, given the magnitude of the UK's trade with the EU, it shouldn't really be a surprise why Brexit has been such a big deal for the pound and why it will remain a very important driver for many years to come. Looking at this chart, we can see that 56% of UK exports goes to the EU, which is why this relationship is so important, not only for the UK, but also for the EU as a whole, which is why the current Brexit negotiations with regards to that deal is so important. Now, turning back to China, this is also an interesting point to make with regards to China versus the US. Now, there is a reason why the tensions between the US and China have a far bigger reaching effect than most people realize, and that is because China's size in share, in terms of the share of GDP on a global scale, is just massive. If we have a look at this chart, we can see that China makes up 15% of the total world's exports. Now, even though they won't like to admit it, the US is a very big deal in the life of China, which is basically 20% of their exports going to the US alone. So as the world's biggest exporters, and obviously the two major economies, any major economic fallout between them will have massive impact on the global trade. And of course, where there is positive and negative catalyst on a global scale, the risk-sensitive currencies will obviously come back into focus. So I hope that this video has been able to answer some of the questions regarding the important correlations. The important thing to remember about these correlations are that they shouldn't really be traded in a vacuum. So it's never just one thing moving the market or one thing moving a currency. Yes, correlations are important and can certainly act as a primary driver, but they are always just one part of the bigger story, so to speak, that we need to keep in mind. So any other questions with regards to correlations, as usual, don't hesitate to let us know.